welcome to Market Open Direct Connect, a webinar series for companies to tell their story, why it's compelling and why it's an opportunity to invest. I'm your host, Stuart Walters, and we're joined here today by Kane Marshall, Managing Director of Australian Oil Company Limited, ASX code AOK. Kane will provide a short company update on recent activities, but the main purpose of today's webinar is to participate in an extended Q&A. You can submit any questions through the Q&A tab at the bottom of your screen. And a recording of this webinar will be available on Market Open and Australian Oil Companies communication channels within the next 24 hours. I'd like to introduce our guest, Kane. Welcome to Direct Connect.
G'day, Stu.
Great to have you on this morning, Kane. Obviously, the last few months, not a lot of activity in the market sense from the company. Can you just give us a little bit of an update of sort of what's been happening behind the scenes?
Yeah, so news has been short, but I can tell you it's been pretty exhausting in terms of the amount of work we've had to do to get to where we are now. So probably since we last discussed what the upcoming activities were, probably back in February, we've been to the US, reviewed what was going on there, and then we've gone through a period where we just went, look, we need to really get a hold of what has been going on in the US. Where's the value? What's happening with our leases before we can really start and get ourselves in a proper recapitalized position to bring other things in the portfolio. So, that sort of investigation into what has been transpiring in this company in terms of a whole raft of management and operational matters has been a fairly rigorous exercise, and I probably don't need to comment any further in terms of where we've got to in relation to the settlement and what that means for the balance sheet, other than to say we're in a position where everything's amicable and everyone's moving forward to actually see some value in the properties there. So there is some value, and that's not been articulated to the market. And also, being recapitalized is going to make and when I say recapitalized, I talk about getting the debt off the balance sheet and talking to companies about a number of transactions. It is almost impossible to move forward on any commercial basis when you've got that debt in the balance sheet, because it's no secret that companies go, well, what about this elephant in the room? So we're able to actually now got a line of sight on how to really evaluate the Californian properties. I can spend a lot more time in terms of growth and deal flow rather than firefighting. And that's where we are now. And, capped at 2 million, and that's pretty much the same as it was with the debt in there. I think once people sort of see where we're going, the stock will re-rate. I've got no doubt about that. But what they want is a few crumbs and carrots as to what's on the horizon. So we can give a little bit of insight to that today about what we're looking at, what we're thinking, and what we're planning to do.
I think importantly, a clear path forward now
Yep.
with some plans to move forward with.
Yep.
I saw some great questions come in yesterday, so we'll get straight onto those. And as I said earlier, if attendees have any questions, please send them through and we'll ask them this morning. How is the redirection of the Canadian gas into LNG exports expected to affect Californian gas markets? And how can AOK capitalise on this shift?
Yes, there's a few things affecting gas prices in California, and I'm sure some people watching this trade gas futures. So they'll have views short-term and long-term, but there's a number of things driving long-term gas prices in California. One, as you alluded to, is Canadian LNG. There's a significant amount of domestic gas in Canada that's going to be redirected to the LNG markets. And that's a combination of some outrageous and ridiculous net zero policy, which is not working, which we can talk about a little bit later. And that's why we've got a significant amount of licensing rounds happening now. But that gas going to the LNG market is, less and less is going to come into California. Now, in our Moulton area, and we'll be showing this in the next few weeks, where we've got 3 wells there. They're currently shut in because we've got a meter there that we no longer have, and we're talking about redirecting those wells into CRC's meter. The huge trunk line that takes gas from Canada into California literally is 2 meters out the front of where our meter was. And so we've got two problems going on in California, or three actually. One, there's no new gas supply. We've got Canadian gas isn't going to come to the California market. And because of the regulatory environment, there's at least two oil refineries slated to be mothballed. And now the legislators are starting to panic a little bit in California because, of course, California was a top 5 economy in the world. Record amounts of gasoline are used there. So in terms of the consumption of gas and what's happening in the Canadian LNG markets is that's just another catalyst. And we'll talk about MP as well, Mountain Pass and what's happened there. Apple subscribing this morning. So really, you've got to be in jurisdictions where you think you can monetize things and the commodity price is favorable. And I would argue certainly that's where we are, provided we've got the right assets.
And what are the next steps to boost production at the rec board wells, and what kind of uplift could result from installing individual compressors?
So I think at AGM, we said we wanted to get to a position of about 500,000 a day gas flows to get this side of the business to be a sustainable business. So we've been free flowing those wells now for quite a while without compression, whereas before they're on our single large compressor. And I think if we redeploy our large compressor there to other areas where we've got other flowing wells, put some smaller individual compressors on those wells, I think we'll get at least 20-30% increase in production there, and may well get close to that 500 number. It's a bit early to say. But, they've been flowing stably on free flow at a lower significant line pressure than what was being flowed at before when we were going to PG&E. So there's that. There's also some near field potential there at Rec Board 5, which we're currently looking at with sidetrack, increase in production. But really, I think the focus is getting the most out of our wells, understanding our lease position, and trying to create some value that the market can understand.
And how does the US government's recent energy and critical minerals legislation, the so-called Big Beautiful Bill, create potential funding or regulatory tailwinds for AOK's growth strategy in the US?
Yeah, I think the big beautiful bill is, I think it's resulting in something like $500 billion will be pulled from wind and solar and hydrogen. It actually is a bit of a tailwind for CCS through tax credits. So it's interesting. The Big Beautiful Bill, not only it deals with some of the tax credits. So let's talk about the tax credits first. Tax credits is good for CCS, which is good for us, because the biggest operator in California is CRC, and their main project is CCS. They're not really focusing on that gas exploration development. In fact, we're talking to them about a number of their properties and potentially what else we can maybe do. We're obviously dealing with them anyway at Rec Board. So that's the first thing, is the tax credits. The second thing is what it allows in terms of leasing, federal leasing of oil and gas leases. So federal oil and gas leases are not just confined to Gulf Coast, but there are federal lands in California, which we earmarked probably last year, areas that are of interest to us. So there'll be more leasing or areas available to lease from Bureau of Land Management. And those royalties in the Big Beautiful Bill, I think, come down from 16.75% down to 12% royalties, where typically we are paying a fifth or a sixth, so 20% royalties. So the royalties are really favourable, more land, and I would argue, given what's happened with Mountain Pass, we'd probably start to see anything on federal lands probably easy to get permitting. So the Big Beautiful Bill is it's terrific. It's terrific for oil and gas. There's a lot more, so making it harder for a lot of scrutiny on wind and solar and hydrogen. More tailwind for oil and gas and CCS.
And now that you've cleaned up the balance sheet and repositioned strategically, how does the company compare to other ASX-listed oil and gas peers?
Well, I think you've got to be a little bit careful. I mean, because a lot of them we're talking to, because you look at the peers and anything that's sub 10 million market cap, look in their to see what debt is in there. Cash, we got a bit of cash, but arguably more cash, no debt compared to a lot of the peers. Those ones that are left recognize that there's not a lot of us around. And I'm arguing that really to get exposure to frontier stuff, particularly big, you probably need to go on consortia. Other stuff, we use our IP and, leverage our expertise to go in on other areas on our own. So when you look at a lot of companies, junior end that, some are capped at 50 million, and you look at what they have, and, I think it won't take much for this company to get recapitalized to a point. First steps, you're at 2, get to 10. Then the tricks get from 10 to 50. So that's the first milestone, get to 10. I don't think that'll take much work. Considering you look at the peers and you look at what, we've got basically no EV on our current assets. We've got rid of the debt. So I don't want to name specific peers, but you could filter easily on the ones that are less than 10 and look at what they've got and maybe what some of their problems are. Some of those problems are being addressed by incoming directors, and they're the people we're talking to about doing things together. So you really got to work a little bit collaboratively as well, because I think everybody knows the tide's going to turn in this space. The net zero thing is not working. Australia seems to be the only country in the OECD that's just not listening to what is happening in terms of power prices and all the rest. And if you're at the table and you're playing your hand, people are going to make some money here.
And there's increasing political and media focus on Australian power prices. What opportunities does this present you in the current policy climate?
Well, Australian government's not listening. That's pretty clear. I think today I was reading that people in Melbourne will know this, that, I think it was record power generation the last 24 hours, and 45% of that's brown coal, which is all being earmarked to be shut down. So we've got a situation here where we're already at a major East Coast gas shortfall. West Australia, nobody's talking about that situation. That's not too far away either. And I'm sorry, but wind and solar is just not going to fit the bill. Gas is a terrific commodity. Getting to acreage is a bit tough because, the regulatory environment has been prohibitive. But likewise, that's also the opportunity. If you're prepared to put up with it and know where to go, a lot of people get a bit jaded, and you're the last man standing, picking up quality stuff, knowing full well that in the next couple of years, things are going to have to change. People going broke, they can't afford to put food on the table. Energy is an input into everything. It's input into transportation, food, power, everything. So I think although the policy is failing Australians, it's an opportunity. It's always an opportunity to make some money, and that's the game we're in.
And what impact might Australia, China, US geopolitical tensions have on the energy policy and exploration investment strategies in or within Australia?
Well, everybody else is looking to for energy security. Look at what Trump's doing. Look what he's doing with Mountain Pass. You look at Brazil, Libya, Morocco, even New Zealand's amendments to their legislation for oil and gas. Every single country is looking for energy security. Every single country. So we're starting to see a much larger change in capital available, deal flow, and eventually that's going to happen here. It's going to be about energy security. We've got, I think, 2 refineries left in Australia. This US-China tension at the moment, I think there's got to be some common sense to prevail. We're going to have security of supply of fuel. We have to security of supply of power to households, not just power, but also to our manufacturing industry for fertilizer and things like that. So I think there will be a knock-on effect to gas, and a realistic view that you've got to have security, energy security. It fuels everything. So I'd argue I think that's also a healthy thing down this end. If you're prepared to do the work, you'll find quality assets, and ultimately longer term, even shorter term, policy is just going to have to change.
Kane, do you see a window for junior oil and gas explorers to collaborate rather than compete in this environment of capital discipline and regulatory complexity?
Yeah, well, probably goes back to that earlier question on peers. I'd say yes. You look at some companies that are in Africa, got a great track record of farming things out, always looking for like-minded people. No, they can't do it on their own. So, I think that I look at like, I don't know, I look at the moment like 10 different deals. And so some of those might go, I think we should go into this with this particular company. They've got a track record of experience in this particular jurisdiction that they're able to get things funded. These guys over here, we know these guys, and so it's a bit of a trust arrangement with people you've done business with before. And look, there's less and less of us down here. So those are left around that you've done business with in the past. I think this has always been a business of having partners. So for sure, it's all about collaboration, and also it's also smart to have partners who are also listed on other exchanges, because then you get arbitrage in terms of how the stocks trade. So there's a number of clever things you can do there to generate some real value in the stock. And that's also making sure you've got some capital discipline, but also you can get some exposure to valuations in capital markets, but depending on who you partner with.
And given these dynamics, are you actively evaluating conventional gas opportunities within Australia in addition to to your Californian focus?
Yes, we're looking at at least 3 projects in Australia at the moment, 2 which are predominantly gas. I think really what punters love is exploration and upside. And upside's probably looking at things like big strat plays in proven basins, adjacent to players with known names. I mean, that's just the game we're in. So yes, we're certainly looking at Australia, we're looking at other jurisdictions, but the prizes have to be big. That's the nature of the beast.
And are Australia's tightening regulatory frameworks in oil and gas a deterrent, or could they become a competitive advantage for well-prepared operators?
Well, California's pretty tough, and we're dealing with that. I've dealt plenty of difficult stuff in Australia before. A lot of companies have just got too top heavy, too many people, too much overhead, and just gets too expensive to do things. And ultimately, you're supposed to be a junior for a reason. That's fast, nimble, you wear plenty of hats, and you get the job done for your shareholders. So I think that it's tough anyway. So why is it any tougher to work through the regulatory issues? I mean, it's a little bit more difficult in Western Australia. It's like at least a year to get any approval on environmental plans for a well. But that can always be dealt with. And there's other areas in Australia you can go to as well, where South Australia, for example, who are very supportive of the industry. So I see, again, those things as an opportunity. It's just about hard work.
And how is AOK managing lease tenure across its Californian assets, particularly for those currently shut in or under review?
Yeah, so we've got the Molten Area wells, like I said, they're shut in. So various leases have got various provisions in them for when wells are shut in. We've got to the bottom of Borba. We've got to the bottom of the actual Dempsey specific lease. The other areas, the wells, apart from those VBC wells, which only recently just shut in, are all flowing gas, including rec board. So they're all held by production. And a lot of the hard work's been done, really. And it's basically now about make sure we've got all the right information available to make sure that all of our leases are in good standing. And also, that's important because there might be other areas of land we want to lease, for example, from the same mineral rights owners. So that's been a fairly lengthy process of trying to get to that point. And I'll add that that's important because when we capitalize our expenditure on the balance sheet, but rather than expensing it, and we actually have reserves rather than just gas flows, that's when we need to make sure the leases are in good standing. We've got tenure. So at the moment, not that anyone really cares, but in the balance sheet, you're basically all the expenditure is just expensed as exploration. It's not capitalized as development. And we need to get to a position where all the expenditure is capitalized. So we're actually capitalizing assets on the balance sheet, and we're making money through gas reserves. And that's not where we are. That's where we want to get to.
Some great questions coming in, so thank you to the attendees. Keep sending them through. We do have some more time. Another one came, what is the commercial potential of the Moulton and Stony Creek deeper zones, and how do they factor into near-term planning?
Yeah, so the VBC wells are a little bit harder because Tahama County is not overly supportive of oil and gas, but there are some deepening opportunities there. And from what I understand is you can deepen wells. New drilling is a little bit tricky to get permitted. And then likewise, you go further south into Stony Creek, we're actually in Glenn County, which is largely supportive of oil and gas. The CRC's got a number of operations there at Willows, the Willows area, for example, and in Moulton on the Glen County side. So the potential down in around that Stony Creek area, which will come out with some information in the next few weeks, is largely on these deeper, untested, or I'd argue untested Tahama Sub-Basin rocks, which have got that bigger resource. And so that's part of our regional review at the moment, is actually understanding, what's the upside in terms of near field step out potential, deep potential, and how does that cascade into a wider leasing strategy, understanding that that's our main undertaking for being listed. But we add some value there, and we look to bring in other things that equally, if not more material. So without breaking the balance sheet, or making sure we're going through some ridiculous ASX submission exercise. So I think that'll all be part of what we put out in terms of news, like what the actual potential is, where are our leases, where are our pipelines, and what's the plan.
So what types of new venture opportunities is the company actively pursuing, and how does it evaluate potential acquisitions or partnerships?
Look, I think focus really is on exploration. We're an exploration company. People make money punting stocks down here for drilling wells. That's how they make money. So, the directors come last, the shareholders come first. And so you've got to make sure that an exploration acreage, you can find the opportunities without paying too much money. Because ultimately, at the end of the day, no one's been doing exploration. And that's going to change for all these thematics we just discussed this morning. So it has to be material. You have to be able to monetize it. And you need to have, if you're going there with partners, I think they've got to be public company partners. I think our days are probably numbered, not repeating history and being involved with private companies in North America. It's notoriously difficult to deal with the accounting side of things, and transparency is a bit of an issue. So, yeah, public companies, like-minded companies, looking at drilling big things in areas that people understand.
And what's the company's current cash position, and will you need to do any raises anytime soon?
I think we're just under $1 million now, and we'll look at all of that, sometime once the accounts. I think the interim financials are August, September. What I will say is that now that one matter in terms of the management review has been done, we would like to get to the bottom of, or would like to finish that whole process before we start looking at going to the market. And we'd also like the investors and the wider capital markets actually see what we got. So and look at where we are, in the next few weeks in terms of what the overall wells are flowing, and what that's doing to the burn over in the US. So that's been reined in a lot. And it's no secret, we've been telling investors that we're trying to get to a position where it's actually paying for itself, rather than just checks being sent, has been done for a number of years without articulating to people what for. So I think there's a few things for us to do before we go down that road.
With the Borba lease now expired, what is the company's process for deciding whether to re-enter or renegotiate previously explored areas?
So with, that there's been when we finally got bottom of this very recently, we're like, well, this is just totally immaterial amount of gas. It's like, it's non-sales specific gas, 1 BCF or less. And any leasing around there, so new leasing, is really about understanding what the deeper potential is. And I think our view is that I don't think they ever got down to the deepest intervals there, or certainly on the work we're doing now. And does that warrant more exploration? Can you promote it? Can you market it? Are companies prepared to put money into it? Yes, I think they will, because we're having those discussions now. Can it be permitted in time? It's a little bit uncertain. So new leasing there is going to be really around having some sensible commercial terms in terms of holding the land, and then secondly, in terms of actually developing anything that we would find if we were to go and drill or sidetrack down there into the deeper reservoir intervals that I don't think are probably fully delineated or appropriately tested from the Dempsey and Borba wells.
What are the technical or commercial challenges preventing consistent production from the Dempsey 1 to 15 well? And are there any realistic path or to economic recovery?
Look, we just think there's issues with the well. I think that the well was drilled it just wouldn't happen here. Probably a little oversight. Anyway, that's in the past. You move on. I think that the rocks there are significantly impaired from having the ability to flow commercial rates. And we need to understand whether actually anything can be done with that well. It's been, I think, 4 workovers and nearly $1 million US spent on workovers, something to that effect, plus the original drilling cost for a well that's potentially not usable. So there's 2 things. One, is there something we can do to the well now that we can get some sort of sustained flow on? In fact, in the next few days, we'll bring it on for a few days to see what it does. And then maybe reroute that through compression to try and get a bit more production there. If that's not going to work, can the well actually be used to sidetrack out and drill that section properly? Or can it be sidetracked to drill out a new prospect? So that's the plan there. And, if it's none of that's commercial, then, we're not going to persevere with it. I mean, we've got to move on and actually do things that are actually going to make some money.
And lastly, what impact has MP Materials development of the Mountain Pass rare earths hub having on infrastructure permitting and resource policy in California's broader energy sector?
I'm glad this is the last question. These are tough. Well, I think Apple's put in 500 million this morning into MP, and the Pentagon's some of your viewers can correct me. I think that Pentagon's like a 15% shareholder there. So that's the only operating rare earths mine in the United States. And it's pretty clear where policy direction's going in terms of resources. Now, I've seen people talk about securing materials for the energy transition. I just think that's rubbish. I think this is about securing critical minerals for defense spending, and not relying on supply chain from China, trying to establish a separate pricing market from China. So energy security in the US is a big thing, and there's going to be a lot of initiatives to fast track approvals, put in infrastructure. And these projects are energy hungry. Where's that energy going to come from? So that's all just good news for us. It's in California. California's got its own set of challenges. I think politically, I think there's a very good chance a Republican governor could be elected there in the next election. I think a lot of people are fed up. A lot of the counties turned red in the last presidential election. And then you're seeing them fund this public-private partnership. Well, I'd argue, where's that in Australia? We need more of that. We need to focus on energy security. So I think it's just another good thing, right? So you've got to focus on the positives. There's a good market there for gas. There's now initiatives in terms of the big beautiful bill. There's the Mountain Pass thing, which is now going to light a fire under the rare earth stocks. Follow the money.
Kane, thank you. That's all that's come through today. As you said, there's some pretty tough and challenging questions there. So once again, appreciate the honesty. As always, I know how much work you put in the background to turn this around. And and put AOK in the forefront of investors' minds. So thank you for your time. Thank you to attendees for some great questions. Really appreciate them coming through. For more information about Australian Oil Co, you can head to the company website, australianoilco.com.au, or follow the company on their social media channels, Twitter and LinkedIn. Again, thank you very much for your time today, Kane. I look forward to chatting again soon, and thank you for everybody for attending today.